Welcome back to the Wall Street Podcast. Today we're doing a deep dive into Goldman Sachs' latest equity research report on Mixue Group. That's ticker 297.HK. The report just came out August 28, 2025.
That's right. And it's a pretty interesting one. They're maintaining a buy rating. The report really details Mixie's solid performance in China, but also talks about these strategic shifts happening overseas and gives some useful insights into where they're headed in the whole freshly made drink sector.
Okay, so our goal here is to pull out the key financial and strategic bits for you, give you a clear picture of Mixue Group right now and looking forward. Let's start with the headline findings. The rating and target price.
Right. So Goldman Sachs is sticking with buy. They've actually bumped up the 12-month price target to HK $570. That's up from HK $509 previously.
And valuation basis for that.
It's based on a 30 times 2026 estimated PE, slightly down from 32 times before. They mentioned adjusting it a bit because of, well, volatile market sentiment is the phrase they use.
Makes sense. Okay, let's look at the first half of 25 performance, domestically first.
Domestically, they really held their ground. Still leading the milk tea market. A lot of that seems tied to their strong supply chain and the brand IP, the Snow King mascot everyone knows.
The report mentioned a dip in July, though, related to delivery subsidies.
Yeah, there was a temporary dip when delivery subsidies normalized. But the key point is volume bounced back pretty quickly and, importantly, stayed above the levels before those subsidies were in place. So underlying demand seems strong.
And how did things look overseas in the first half? The report called it a transition.
Definitely a transition. You saw a decline there, but it seems quite deliberate. Management clearly shifted focus. They prioritized store-level profitability rather than just chasing volume with subsidies.
So less of a land grab approach overseas for now.
Exactly. It signals maybe a more mature, sustainable approach, building for the long term. Interestingly, though, they saw strong per-store sales growth in places like Vietnam and Indonesia. And they're pushing into new markets, too. Kazakhstan, Japan, South Korea mentioned.
Okay, and the outlook for the rest of the year, second half 25.
Continued solid China operations expected. Plus, more focus on brand building, product innovation, and, crucially, investment in that global supply chain and operational capacity.
Right, let's talk strategy. The report laid out 3 main pillars for growth.
Yes. 3 key areas. First is market expansion. Keep growing the network in China, but also really push internationally. Southeast Asia, but also the Americas, Mexico, Brazil are named. Using the franchise model.
And the second pillar?
Supply chain enhancement.
Right.
This is big. Major infrastructure plans building flexible supply chains. They're talking 5 major domestic production bases in the next 3 to 5 years.
That sounds like building a serious competitive moat.
It really is. Controlling the supply chain in this kind of business is huge.
And the third pillar?
Brand and IP development. Making the Snow King IP even stronger. Taking it global. Think multilingual content, co-branded products. Building that recognition worldwide.
The report also mentioned the Lucky Cup brand, their coffee offering.
Right, Lucky Cup. Focus there is fresh ground coffee. Their edge seems to be direct sourcing, getting beans straight from places like Brazil, Colombia. That plus a clear franchise setup and price strategy helps them compete in coffee.
Okay, let's dig a bit deeper. You mentioned overseas is still in transition. What's the underlying strategy there? Balancing growth and profitability.
Well, as we touched on, the first half really showed that pivot. Management chose profitability over just sheer volume growth driven by subsidies overseas. For the second half, the plan seems to be less about just opening stores everywhere and more about developing the IP, making the supply chain work efficiently for those markets, and really optimizing store operations. It feels more calculated, for long-term success.
Got it. Now, margins. The report mentions a target gross profit margin of 30–35%, but also notes an expanding OPEX ratio. How do those two square up?
Yeah, that expanding OPEX, the operating expenditure ratio, is directly tied to those big investments we talked about. Global supply chain, operational capacity building that costs money upfront.
So how do they protect margins?
2 main levers mentioned. One is strategic price increases, where possible. But the bigger factor seems to be pushing hard on supply chain efficiency to offset costs, raw materials, labor, rent. Goldman Sachs actually anticipates stable gross and operating profit margins in the second half precisely because of these optimization efforts kicking in.
Okay, last question module. Valuation and risks. The target is based on 30x 2026 PE. What are the main downside risks investors need to watch, and how are they addressing that volatile sentiment?
The main risks highlighted are pretty standard for the sector, but still important. Things like slower than expected store expansion, more intense competition, food cost inflation hitting harder, any food safety issues, and of course, risks in executing that overseas strategy smoothly.
And the volatile sentiment point.
The fact that they adjusted the PE multiple down slightly from 32x to 30x suggests they are factoring in that broader market uncertainty. Mixed answer to that seems to be doubling down on fundamentals, those investments in supply chain, brand IP, and a more measured overseas approach. It's about building resilience.
Shifting gears slightly, what does all this mean for the average consumer?
Well, the market expansion piece is straightforward. More mixed stores in more places, potentially globally, in markets like Japan or South Korea, plus more variety with things like Lucky Cup coffee. So greater access and choice.
And the supply chain focus.
That investment, if it pays off, should mean more consistent product quality, maybe even helps keep prices competitive over the long run. It's all aimed at a better customer experience, better value.
So, summarizing our deep dive, Mixue Group seems to be managing solid growth at home while executing a careful strategic pivot overseas, all underpinned by major investments in supply chain and brand.
Exactly. Which brings us to a final thought for you, our listeners. This analysis of Mixue raises a broader question. How will this balance between aggressive expansion and really careful operational efficiency shape the future for all global freshly made drink companies? And what should investors expect in this kind of evolving consumer market?